Next up, we have Mr. Jan Art, the founding managing partner of Holt Exchange. He'll be delivering a talk on venture capital as an asset class, the future of alternative finance. Over to you, Jan.
Thank you, FFCon, for another fantastic event yearly at this point, and a very necessary time at that, as we're all trying to navigate the challenging times. Well, also encouraging still fostering innovation with all this new advance of technology. I'm Jan, founding managing partner of the Holt Exchange, and I'm here to give a quick talk on a quick why and how of VC investing. This is especially geared towards new or those that are interested into accessing and entering the VC investment landscape. So let's get right into it here. We at Holt Exchange do believe that every person should hold a portion of their portfolio in venture capital. And so what we actually have seen, let's give a little case study here. If we look at the mix from CPPIB, Canadian Pension Plan here, the largest pension in Canada, and in fact, one of the largest in the world, it holds roughly about 61% of its assets in alternative assets, right? So you would think from the traditional investment side, the equities and fixed income actually represent a relatively smaller proportion of the overall asset mix, right? Now, what do we mean by alternative investments? So if we look over to the right, that's more just the industry standard that I'm talking about here. So this is alternative assets. It's a growing asset space for which represent about 6.7 trillion in 2015, according to Preqin, and is has actually already reached a 13.7 trillion in 2021. That is up 50% and projected actually to reach 23.3 trillion by the end of 2027. So that's up 70%. Now, a big piece within that, if you look there, is venture capital. So that proportion of venture capital is actually growing in each of those segments. It actually reached about 14% of the alternative asset class in 2021 and projected to reach 21% in 2027. So by applying those percentages, right, high level into the CPPIB, you could actually estimate that you should hold for a pension fund of that size roughly 8.7 to 12.7% by 2027 within the venture capital space. Other research indicates, yes, you should be holding 10%, some as low as 5%, of course, depending on your risk profile, your risk tolerance, your timing, all those things. But it's definitely a growing asset class, an increasing one that we all must consider here. And it continues to grow with respect to other traditional places from what you would expect alternative investments investing previously. For instance, the buyout space was a very hot space for many years, investing into company and flipping in 3 to 5 years' time. On the flip side of that now is the idea what's growing proportionally against that is the idea of venture capital and growth equity. So it used to account about 40% of the buyout industry as a whole, and over the last 10 years has become 83% of the buyout industry, right? So substantially a faster growth rate relative to the buyout industry. Now, why investors continue to flock here is simple. One of the biggest reasons is the idea of diversification, right? So while there is still correlation with the markets, and sometimes that's a little bit lagged, there is diversification to be had from an overall portfolio perspective, why they continue to invest in that space. The other is just the potential for high absolute returns. So this is within this particular bucket, VC would actually fall into the private equity segment. It actually wasn't removed, but it still yields the same insights on why people are continuing to flock to this space. And just how good are these high potential returns? Well, over the last 6 years, during a relatively strong bear run, we saw about on average 15% per year is what you would expect. Now, if you were a multi-regional venture capital firm like us at Holt Exchange, where we are as well, you would expect more of a 20% annual compounded annual growth rate. In the last 3 years alone, it got substantially higher. We all know valuations substantially increased. So it was a very interesting time, especially we saw, sort of low 20% annual returns in this particular case. Now, going forward, we do expect it to renormalize. I mean, we are entering a very interesting time, a challenging time where valuations are certainly getting hit. And so we're expecting to recalibrate, but for a long term over the next 6 years, still projected to hit about a 14% return, for upwards of 15% return. Now, what's interesting here, though, there have been lots of studies, specifically Harvard Business Review came up with a report that showed that funds raised during 2007 to 2016 beat out the Russell 2000 by 7% a year and 5% on the S&P 500. So these were funds raised I'm talking before, during, and after the Great Recession. So another way to look at this is, on average, 75% of VC funds actually outperformed the Russell 2000, and 60% had beaten the S&P 500. These are just average funds in this particular case. So it also pays to find the better VC funds that are performing. Another study from the University of Miami illustrated that venture capital returns during the dot-com and Great Recession actually averaged 16.4%, while the NASDAQ declined 17.7%, and the S&P 500 slipped 12.32%. So that is a 34% difference on the NASDAQ, illustrating that, yes, it's still very interesting to invest into this asset class right now. Now, you've made up your mind, perhaps, okay, I'm interested, I want to invest. How do I go about doing it? A key is good deal flow, being a deal junkie. How do I get in front of as many deals and process as many deals to make sure that I do invest? I can benchmark the top companies and invest into the top percentage of the ones that I've looked at. So the whole process, we track about 10,000 fintechs, and we actually have a data-driven approach to identify the top 1,000 companies, which then we spend more time with our team manually sifting through at that point. Of those ones, the top 100 actually move to an interview phase, a more in-depth phase, and that also tends to include one of our advisor army, as we call it, a Holt advisor army, who is a subject expert and relevant to that particular company, so that we can actually see if and get feedback from our market network. And as those top companies continue to advance, and we see when we like what we see, the top 20 will advance and engage with up to 100 of our Holt advisors, and we collect all that wisdom of the expert crowd to help us identify which ones would be the best fit within our market network. So then we move into due diligence, and we assess them deeper in terms of what the product tech stack really is and its market potential. And only 4 through that rigorous process we'll fund. And this was last year's process, in fact. And these findings are pretty standard, what you would see from other angel groups. In fact, a great report by NACO showed that their 2022 report, you would see roughly close to 8,000 applications that were out there, of which only 20% would actually make it to the presentation stage. So 1 out of 5 actually make it to the ability to present. So it shows you the importance of, if you are an angel and are championing a deal, making sure that you put them forward and find the deals you like and bring them into the council to review. Or if you are a startup applying to angel groups, make sure you find a champion internally to give you a greater success. Now, those that did present, only 6 roughly a quarter of those, just over a quarter, moved to due diligence, and then just under that those would be the deals that get funded. So roughly a quarter of those that move to presentation are the ones that actually get funded. There is a good chance that once you move to due diligence, you will be funded, as shown from the results here. This shows the importance of also not lying or misrepresenting and creating aspects of areas of non-trust that could break and have the deal fall apart. Of course, there's other reasons why deals fall apart, but just shows that once you get to due diligence, you have a good chance, as long as you represented everything okay. Now, okay, so you got to that point where you found your companies. So how do you invest, and for how much? What we see here is valuations on our side. While we are multi-jurisdictional, so we have invested a lot in the US or the UK, these are markets that have higher valuations. We've also invested in areas that have substantially lower valuations, that just have less access to capital as well. So we've offset the high and the lows to find just good quality companies that make sense from an investment standpoint, that we can back, that can enter the North American market. That said, we also invest in fintech. So I'd say building fintech, obviously these valuations are a bit higher, the money that you require to build these. Of course, once you do build, we're talking multi-million-dollar deals in many cases. So the hockey stick curve, the inflection curve can flip up very aggressively, and you can get to higher valuations. So we've certainly not been afraid to invest a little bit later. And as you can tell, about 60% have been over 7.5 million Canadian, with a smaller proportion of 40% under that amount there. Now, valuations are certainly looking to recalibrate now. So it's a very exciting time to invest at that. So what we're seeing is companies were previously raising at like 30x multiples on top of projected revenues, not in real revenues. And that has certainly recalibrated all the way back down to like 5x for fintech. There's even some would argue an overcorrection that's occurring relative to SaaS and enterprise. And we don't expect that to last forever. So there's a good time to invest here, to invest in good companies and take advantage of those opportunities. Now, that's not always the best indicator at the early stage, just to note. I mean, we have hundreds upon hundreds of every year of negotiations and valuations we see, so we can compare jurisdictions and industries and founders alike to see how they compare relative to others. So there's a lot of benchmarking. So comparative analysis is key here, which is very difficult to do if you're an angel and you're by yourself. It's all the more reason why we, grouping with others to their funds make more sense to support in this initiatives. And that said, sometimes we also look at where they could get to at that funding round. What would be the price down? What would be those milestones? Are they plausible to get to there based on the metrics, the objectives, the key results, the actions that they're taking, and then discounting accordingly back from that. So we kind of look at a two-pronged approach to be able to assess the valuations at that point. Now, the other side is, okay, so once you've decided how much to invest, what sort of vehicle do you invest into? Now, preferred shares are interesting. They usually come with better terms, but they're challenging to assemble. They take a lot of work if you've never done them before. So more often than not, it's for those that are investing a substantial amount. It also, you need to encourage the founders to accept pref shares, and then there's legal structures to assemble. So it generally goes to a lead investor. So in many cases, you either are the lead investor, but if you're an angel in this case, you'll be lucky to be able to follow. You need to keep your ears to the ground, or part of the fund that opens it up to you. More often than not, what's very common in Canada is the ability of more convertible debt. One thing I would notice on preferred shares before I skip over, in fact, is you do want to be on the lookout for more majority investor terms that might disadvantage you by participating, or advantage you if they're pref shares. Things that you really want to have is pro rata rights, the ability to follow on next financing rounds, so to protect your dilution, or tag along, drag along rights. So you don't get stuck in an entity and the major investor is now gone and you have new investors coming in, you can never really exit your capital. Or the exit path becomes certainly more uncertain, putting the investment at further risk. Now, what's very common, as I was saying, is convertible debt. So this is the ability to invest into a vehicle with an interest-bearing amount and be able to receive that in a certain time period. And that can, in the future, flip into equity if you choose. Usually, the option depends on who holds it, but it's generally for the investor who gets this. That said, more often than not, if the company's doing well, you're going to flip it into the company. And if they're not doing good, well, they don't have money to repay you. So what we do see more often is the prominence of safe notes that actually open up a greater investor pool, especially to our neighbors to the south in the US who actually prefer this instrument. More rare, you see common shares. It's more at the friends and family round, and that's more the founders moving quickly and saying, hey, invest in these terms, and trying to keep everything one share class. But generally, as you proceed, it becomes very challenging to be able to maintain common shares. So those are some ideas of the ones that you flip in. We've played in all of those. And if you don't have experience in it, again, it's important to invest alongside others that do, so you don't avoid any of the mistakes during the negotiations process. Now, if you're looking to build your own sort of portfolio of angel investments, the challenge is you generally want a portfolio of at least 40 investments. So it makes it very challenging to do by yourself. The reason you want that is you want a lot of at-bats. You want to give yourself the opportunity to hit like that 50xer at the early stage, right? To completely pay back all the mistakes that you've made. A lot of the missed hits or misfires, a lot of companies are going to go under, they're going to fail. So if you can't build a portfolio size, you might want to consider investing into a fund. Is generally excuse me, what is considered here, right? And so the other side is not just being able to make all those at-bats, but also saving and reserving roughly 40 to 50% of that fund into follow-on investments. So double downing on the best companies. This is just a way to model out what you could expect if you're trying to get to what a fund usually boasts, at least a 3x multiple. You have other funds that boast higher and they can yield those returns, but that just shows you what sort of venture math that you would need to make this happen. Again, very challenging if you're by yourself, putting too much risk on too many of your companies failing and not actually getting any of those funds to return your money back, and therefore having substantial losses on your investments. So for those that are interested in investing, we do have our platform fund open. I'm happy to discuss our raise or anything else. If you are interested in our investments, I mean, we are tracking to a 3x multiple on the cash invested. We have an exclusive network of LPs. We have our own tech stack that enables us to track all those companies and deal flow and participate in. And what's really unique, though, and what you'll see is our ticket size now is as low as $5K, and it's opened up quite soon. It's already to accredited, but non-accredited investors as well. We've worked hard to further democratize access for everyone to participate. Most funds, it's very challenging to find good funds to enter in, and it's also challenging to invest because usually minimum ticket sizes are 100K, 250K, millions of dollars. So great opportunity to, if you're at the very least, always happy to discuss. Feel free to reach out to me if you're interested in discussing the mechanics around VC or participating in the last bit of our fund that remains. Thank you, FFCon. Thank you, Craig, for this time. And I hope you enjoy the rest of your event here today.